Are you hearing friends and colleagues, maybe even complete strangers on social media, complaining about the cost of living? It's increasing. Gas, food, clothes, you name it, everything is more expensive than it was this time last year. We are spending more than ever just to live. Financial storms are brewing all around us, and it's time to make some strategic changes. So let's first start with what is a recession, and how do we know if and when a recession will occur? How do we be prepared for a recession? Answers to these questions and more on this edition of Ask the Lender. If you haven't already, show this channel some love by subscribing and clicking that bell right there to get notified. Also, stick around a little bit longer as I share the 5 recession indicators you should be tracking. So let's get right to the good stuff, and we're getting started right now. Hello and welcome to Ask the Lender. Thanks for checking out this video. This is your go-to channel for advice on current market trends, wealth building strategies, how to pay less money in taxes, plus housing market and mortgage advice. So let's begin by understanding that a recession is normal, okay? And albeit an unpleasant part of the business cycle, it happens. They will always happen as a result of excess government spending, like what we have recently witnessed. So when you put too much money to work in the economy, the cost of living and inflation shoot up. And look, a recession ultimately follows. Most people have the same images and ideas of a recession. Recessions are generally characterized by a rash of business failures and often bank failures, slow or negative growth in production, and elevated unemployment. The economic pain caused by recessions, though temporary, can have major effects that alter an economy. A recession is defined as a period of declining economic performance across an entire economy that lasts for several months. Now, that rule used to be 2 consecutive quarters or 6 months, but that was changed by the NBER to several months. Now, the NBER, or National Bureau of Economic Research, is the organization which officially declares a recession. They closely monitor several leading indicators such as consumer price index and GDP, or gross domestic product. Inflation has reached a 4-decade high. Now, in the Department of Labor's most recent Consumer Price Index, or CPI report, inflation had risen to 7.9%, but that's not the real number. We'll talk about that in another video. But let's compare that to a year ago, as the price of goods and services have skyrocketed. Investors also closely monitor several additional indicators, such as jobless claims and also the yield curve, which we will discuss in just a second, to make sure to stick around. Looking at January and February, the most closely followed leading indicators are trending even more negative. With the recent spike in gas prices, these leading indicators will trend even worse in the upcoming months ahead. So what key indicators should you, the average American, be paying attention to? Here are the 5 key indicators that we are headed into or maybe already in a recession. Key indicator number 1, consumers start to lose confidence. Consumer confidence was down slightly for a second consecutive month in February of 2022. Across all income levels, just 18% of consumers said their wages were keeping pace with the higher cost of living. And in February, 73% of lower earners, which are defined as those household incomes of less than $25,000 annually, this segment said that they felt the impact of inflation already. Considering gas is at higher prices than pre-Great Recession, we are spending a lot more in the grocery stores for less product. Do you really think that consumer confidence will increase in the months ahead? I seriously doubt it. Key indicator number 2, interest rates get weird. Now, don't be confused, as this is not referring to mortgage interest rates, but rather the yields. These yields are interest rates on U.S. securities. Once that yield curve becomes inverted, it's time to make adjustments to your finances. As of March 4th, 2022, the U.S. Treasury yield curve was recently inverted. What is an inverted yield curve? An inverted yield curve means that a short-term U.S. Treasury, such as a 3-year note, for example, is paying a higher interest rate than long-term U.S. Treasuries, say like a 10 or a 30-year note. And this unusual occurrence has historically been a very reliable indicator of an upcoming recession, as it reflects investor sentiment about future economic performance. Key indicator number 3, unemployment shoots higher. A rapid rise in America's unemployment rate is a sign that a recession is either coming or has already taken hold. The real unemployment rate, or U6, was 7.2% in February of 2022. This was much higher than the reported unemployment rate, which is, they use the U3, and that is 3.8%. But I don't have a lot of time right now to explain the difference between these two calculations, but just know that the U6 is the real unemployment number, and also the one they hide from you. You should also know that 4.3 million Americans quit their job in January of 2022. According to the U.S. Department of Labor's JOLTS report, issued on March 9th, the current level is near a record set just back in November of 2021. Now, in the year 2021, 48 million Americans quit their jobs. This is a record number, 48 million. And we are already ahead of that pace. Hundreds of thousands of Americans quit their jobs as a result of vaccine mandates. So with a lot of the companies rehiring, you should pay attention to how many people are quitting their jobs versus being hired. Key indicator number 4, sales of new cars decline. Sales of new cars remain down by a quarter on pre-pandemic levels as the global shortage of computer chips limits supply. Now, the Russian-Ukraine war can hit the global supply chains that are already constrained due to the pandemic, and the worst impact will be on ongoing chip shortage because these warring nations brutally control supplies of key raw materials that go into making semiconductors. Russia controls as much as 44% of global palladium supply. Ukraine produces a significant 70% of the global supply of neon, and these two key raw materials, these are the ones that go into making these computer chips that are already in demand and short. So this means fewer new cars produced, and you can't sell what you don't have on your lot. If they don't make new cars, they're not selling new cars. Key indicator number 5, inflation heats up. You are already feeling the flames of inflation, and if you are watching this video, you're probably feeling those flames as they burn through your bank account. You don't need someone to tell you that everything is more expensive. You're living it every day. Now, currently, the Fed says that inflation is at 7.9%, which, in all fairness, is higher than their target of 2%. But the way that they calculate inflation now is much different than it was in the 70s when inflation was considered they considered the inflation of the 70s as the highest ever. And now we have even higher inflation than the 70s. So if you calculate inflation the same way as then, we would be over 20% inflation. How do you feel after buying groceries and putting gas in your tank? You probably don't feel too happy. You probably want to get a mortgage just to fill up your tank with gas, right? So my objective in sharing this information is not to discourage you, but rather to help you be prepared. Buy 1 or 2 extra items when you go to the store. Chances are it's going to be more expensive tomorrow and the next day. And if you own a home, you should consider doing a cash out refinance while you have the equity and rates are still at historically low levels. You should access the equity in your home before rates get even higher and home values stabilize or maybe even decline. Look, I'm not expecting a 2008 version of a foreclosure crisis which saw home values plummet, but it is clear that fewer potential home buyers are being pushed out of the home buying market. They are very concerned about their finances due to the higher cost of living, and they're somewhat nervous about overpaying for a home. And home values may not drop 20 to 30%, but they will taper off. You're not going to see any more of this 20, 30, 50, 100,000 over asking price. Plus, with rising rates, even more new buyers will not be able to qualify because of their debt to income ratio. The market is looking like it will cool off sooner than expected. So the bottom line, if you have equity in your home, you should consider doing a cash out refinance or maybe even selling your home. In either scenario, make sure to connect with me. You can check out the description below for more important links. Also, if you do have money in the stock markets, in the bank, or in home equity, I have created a video just for you that explains how you can get up to 14% returns, participate in stock market gains while being removed from the losses. Also, you access this money tax-free in retirement. It's safe, it's stable, and it's secure. So watch this video that I've created for you right here. Watch this video, and I'll see you next time on Ask the Lender.